Good afternoon and welcome to our presentation, Why Your Company's Insurance Costs Might Be Down and How to Capitalize on the Situation. My name is Susan Givens and I am the publisher of Auto Success and the moderator for this event. Today's webinar is sponsored by Dealer Shop. The cost of employee health insurance is one of the biggest expenses a company incurs. Even a small percentage savings can have a huge impact on your bottom line, so you need to pay attention to the trends. Our webinar presenters will discuss the long-term trend line with employers' health insurance spending, why costs went down in 2020, strategies you can use today to optimize the current situation, and how you can prepare for the cost increases in the future. First, I'd like to address some housekeeping items. As part of this webinar, we will have a live Q&A session. Our speakers today will address as many questions as they can during the last portion of this event. Please submit your questions throughout the webinar. To improve the chances of your question being addressed, don't wait until the end of the event to submit them. Ask them as they occur to you. To send in your question, just type it into the Ask a Question box, then click Submit. This webinar is being recorded and it will be available on demand for you to view. We encourage you to direct coworkers to the recorded presentation. You'll receive an email with a link to the on-demand version in a few days, and it will be on the Auto Success and Body Shop Business website. Looking at the widget bar at the very bottom of your console, you will see icons that allow you to open and close windows on your screen. When you place your cursor over any of these icons, you'll see the name of the widget. You'll notice there's an icon for Facebook, as well as an icon that lets you send an email to a friend about today's webinar. There's also an option to print a certificate for attending today's webinar. You can access this by clicking on the yellow certification icon. If you need help at any point during the webinar, just click on the question mark icon for some troubleshooting tips. And finally, if the slides stop advancing or if you're having problems with audio, try pressing the F5 key at the top of your keyboard. It will refresh the webinar console on your screen. Now let's get to the good stuff. I'd like to introduce our presenters. We are happy to have Bill Grazinia, President and CEO of Dealer Shop. Bill established Dealer Shop in 2020. He was formerly CEO of Axletech, maker of off-highway and specialty vehicle powertrain systems and components. We also have Teresa Skotak, Vice President of DMBA, joining us today. Teresa is a global human resources and organizational restructuring expert with more than 2 decades of HR expertise. Her background includes serving as Vice President and Executive Vice President of mid-sized to Fortune 500 global manufacturers. Now, let's get this presentation started. Teresa, the floor is yours.
Thanks, Susan, and welcome, everyone. What I'd like to do is first set the table here a little bit with what's going on with the healthcare trends. So if you could advance the slide. There we go. So this slide here it basically tells you what's been going on with healthcare costs for the last decade. And as you can see, from 2012 until right at about the middle of 2020, healthcare costs continued to rise year over year. And year over year, employers continue to try to find ways to bend the trend and reduce their costs, either through passing some costs along to their employees or changing their plan designs. But out of necessity, they had to address rising costs. Then in 2020, something unusual happened. COVID hit, and as a result of COVID, employers' healthcare costs surprisingly started to go down. So what we're going to cover here today is not only the fact that the healthcare costs may have gone down for you, but why did they go down, and then what should we be doing in today and in the future to position your company in a way that you can realize those healthcare reductions for years to come. So, next slide. So why the steep decline? Well, there's a number of reasons, but we look at it in terms of 3 primary reasons. One is that loss ratios, which as you know are claims and premiums, went down. COVID regulations required doctors and hospitals to postpone or cancel non-essential procedures such as back surgeries, hip replacements, etc. And as a result, your claims costs went down, and therefore your premiums went down. In addition, more focus was placed on technology and innovative solutions to deliver care. For example, telemedicine, which has been around for years, became popular, again, out of necessity. People didn't want to go to the doctor, they were afraid to go to the hospital or to urgent care, and as a result, they took advantage of the telemedicine options that their plans offered. As you might expect, telemedicine visits are much less expensive than going to an urgent care or an emergency room. That then translated into claims costs going down and your rates going down. Another reason for the decline in insurance costs are company shutdowns. A number of companies closed, went out of business, or temporarily closed their business, and as a result, claims costs went down. That reduced the demand from the insurance carriers, and that caused the carriers to then have to become more competitive in their pricing. So when we look at how can we capitalize on these latest trends and maximize our savings, there's a few things we have to think about. First is we need to understand the breakdown of our healthcare spend. Once we understand the breakdown, then we can identify and put in place controls to manage our healthcare dollars. We also need to take actions to mitigate our risk and move costs away from the company. And that doesn't mean move costs to the employee, it means move costs away from the company and to other solutions. Finally, we need to audit our spend to ensure that we're maintaining competitive benefits that allow us to attract and retain talent. So on the right side of this slide, what you'll see is the breakdown of our average dollar of healthcare spend. So the first bucket shows that we spend about 23 cents of every healthcare dollar on physician services. One of the things that we can do, and particularly now when it's becoming more and more popular anyway, is to make sure that we continue to encourage our employees to use telemedicine solutions as opposed to making doctor's office visits when it's appropriate. The next thing you'll see, and we'll talk about it in a little more detail on the next slide, is that our prescription drugs, we spend 21 cents of every dollar on prescription drugs. And so if we take advantage of some of the technological solutions that are available to us today, we can reduce our prescription cost spend without compromising either the quality of those prescription drugs or the quantity. Outpatient services and inpatient services make up 37 cents of that spend, and what we need to do and be sure that we're mindful of is that we're constantly benchmarking those costs and comparing them to the market to be sure we're getting the most value for our dollar. And then 14 cents is spent on administrative costs. You would be surprised to see how often we find that administrative costs creep up over the course of years for employers, and so we want to be sure that we're looking at those costs and benchmarking those against market and incentivize our employees to make good decisions. And then last, and probably not least, but nothing we can do about, is 5 cents of every dollar goes toward taxes. So I mentioned before, 21 cents of every healthcare dollar that we spend is on prescription drugs. And so this chart is an example. It's one drug that we put up here for you, which is Celebrex, or the generic version of Celebrex. And as you can see, in a 5-mile radius, that drug sold for as little as $9 at Costco or as high as $66.02 at Walgreens. So even if you have a plan where your employees have a flat copay, you as employers are being charged for those claims. So what we want to do is we want to encourage our employees to take advantage of integrated solutions so that they're mindful of where they're getting their prescriptions filled. Again, this is a 5-mile radius. They could have gone to Costco, grabbed that for $9.01, and in some cases, because their habit is to go to Walgreens, it was $66.02. This is an area that we can focus on to continue to reduce our spend. Next thing that we want to look at here is other actions that we can take to reduce our healthcare spend. So in that previous slide, we covered mitigating risk, and that's what this slide is about. One, when we look at just these three areas, working spouse rules, pre-retiree education, and transparency tools, these are all suggestions that we're making that employers should consider in their plan. That doesn't change the plan design. It doesn't change the quality of care. It causes employees to be more mindful when they're deciding on whose insurance to sign up for, whether it's theirs or their spouse's, and also to be thinking about what's the best value for their dollar when they're buying insurance. So working spouse rule. Not every plan has this, but every plan should consider having it. Employers can implement a rule where they can charge a surcharge for a working spouse who has access to coverage through their own employer, or they can offer an incentive for that spouse to opt out. Or in some cases, and although not always, employers have decided to exclude working spouses from coverage availability as long as that working spouse had access to coverage through their own employer. The second one that we think about, and I honestly think that this one has a lot of upside opportunity for claims savings as well as for the employee to get high-quality care, is pre-retiree education. A lot of employees are not aware that with the Medicare rules today, that they can actually get better coverage if they're 65 and over. They can actually get better coverage through Medicare than they'd be able to get through their employer. And they can get that coverage for a lot less per month. So the average Medicare premium is about $148 a month, while the average COBRA premium, if the person is retired, is several $100s higher than that, depending on the employer's plan, because as you know, COBRA is 102% of the premium. So we want to make sure that what we're doing, and this is what we do for our customers, is we offer to provide that pre-retiree education to be sure that our up-and-coming retirees are taking advantage of the best plan for them. And then finally, offering transparency tools. So these are anything from educational tools to reports to offering advice through our carriers in terms of services that employees may need. So those are three areas where you can take action and continue to realize the claims reduction even when the effect of COVID goes away. All right, so these are two more areas that I want to talk about that I think are important for employers to be cognizant of. And one is that, you know, as dealerships and collision centers out there, you want to be sure that if you have more than one rooftop, that you're taking advantage of national coverage. We have a lot of customers who have facilities in several states, and we want to offer good coverage to all of our facilities. We want to make sure that it's a national network that has a lot of representation in the local market. So take a look at your markets and be sure that you are offering national coverage with the largest providers. Well, why is that? Well, those large providers are able to leverage their, we call it leverage their buy, or leverage their claims. So they can negotiate steep discounts with hospitals and providers that local carriers are not able to negotiate. You also want to consider when you're looking at your health care spend and you're looking at what you're offering for your employees is that you want to be sure your networks are matched. And that's because you want to reduce the disruption to your employees. So when you think about benchmarking to the market, we recommend that you always consider matching your network and making sure that your plan design is working for your employees and making sure that you're getting the lowest cost possible while maintaining that large network in your area. Continuing on, we want to consider marketplace flexibility. There's no such thing as one size fits all, really. We have employees at different stages in their life, and they have different needs. So we want to be sure that we offer employees a comprehensive menu of options. Most employers go with the PPO and an HSA, and some employers still continue to offer HMOs, and those HMOs are appropriate for certain population demographics. Each company needs to stand on its own, and that's what happens with the folks that we work with, is that each company stands on its own, but we leverage the buy. We have I think it's about 90 million under contract, and so that allows us to be able to negotiate better discounts for our customer base. And then you want to be sure that your pricing that you're getting from your brokers and your networks, that your pricing is at or below the national average. Again, benchmarking with the national average, and this number here I think was from 2020, and the national average was 58.33. So when we look at it, if we aren't able to provide, about $1,000 per employee per year in savings, then we need to go back to the market. All right, here's a couple case studies that we thought would be useful in sharing with you so that you could see that we're not talking about passing costs along to employees. We're really talking about paying attention to the plan design, paying attention to the network, making sure we're leveraging the buy, making sure that whoever we're talking with as a carrier, that they understand the claims that are out there, the historical claims, what's going away, what may be continuing, etc. This is a self-insured program that we put in place last year for one of our customers, and in this program, we actually had a conversation around claims, and that is true. When you're self-insured, your claims are your claims and you're paying them. But discounts do matter, and our large carriers are able to negotiate discounts that results in lower claims for you. But there's other areas in your plan that you want to think about if you're self-insured, and you want to be sure that you're negotiating, or whoever's negotiating on your behalf, they're getting the best rates for you. One of them is in stop-loss savings. In this particular case, we were able to reduce the stop-loss cost by $455,000. Those are real dollars. And then in addition to that, you want to be sure you're getting your ancillary coverages with guaranteed savings. Our particular plans offer a 10% guaranteed savings and a 2-year rate guarantee. Other programs may offer similar or maybe less. And then finally, you want to think about these other types of savings that you can get when you're looking and benchmarking your plans. Can you make some plan design changes that do not have a negative impact on your employees and wring out some savings? In this employer's case, we were able to get another $30,000. We also were able to get some anticipated savings through wellness programs of another $58,000, and then through our negotiated discounts another $25,000. So in this particular case, we saved our customer 22% on a $3 million spend, and that was for 1 year for $614,000. What's important for me to point out here is that when we are going through this process, we are either asking for rate guarantees or caps to be sure that our customers are getting the best deal year over year. The next case study is for a fully insured program. We have a lot of clients that are fully insured. This is one that we put in I think it was around August of last year. This particular company had an annual spend of about $600,000. It was a fully insured program, and we were able to find $100,000 in savings for them. This is for a 12-month rate guarantee and a cap. They were also quoted a 17-month rate guarantee with a little bit lower savings. So you want to think about, what's your strategy for not just the next 12 months, but what's the strategy for the next 24 or so. And this is a small employer, and they had 59 employees. So then you want to talk about, and you want to look at your cycle, if you will, from the time you start thinking about your healthcare solutions and the time that you implement whatever your plan is going forward. In our particular case, we have about a 30-day cycle from the time we receive the information that we need to quote the business and the time we can go live. And I want to point out here, because I think it's a misconception with a lot of employers. It certainly was one of mine many years ago, and that is that employers tend to think that they can only make carrier or plan changes one time a year during open enrollment. And although that is normally common, these things can be done with a 30-day notice. And so employers who are looking to realize savings right away, as long as we have about 30 days to quote the business and get it implemented, it can happen that quickly. We will need the information, and it needs to be provided in a timely manner. But otherwise, it's about a 30, maybe even, I could say, 45-day process before you could start realizing savings. So that's the timeline on this chart here. And as you can see, we have a number of steps that take place. We have a team of people that work on the DMBA. We've got people who are analysts. We have actuaries who actually look at the plans before we send them to the customer or to the provider's actuaries. We do talk to our customers about plan options. You want to be sure you're thinking about it from your particular employer perspective. Then we create the playbook and implement. So that's it for me as it relates to the health insurance. I don't know, do we have questions coming in?
Well, I just had one slide, Teresa. This is Bill Grisania. Welcome as well. One slide on Dealer Shop, which will explain our connection to insurance, which we call Dealer Shop Member Benefits Alliance, or DMBA, as Teresa reviewed. You can see here our connection to insurance and how we're able to save you significant money on things like insurance. We were founded about 40 years ago, actually, in Quebec, Canada, under the name Leader Auto Resources, or LAR. And more recently, about 12 months ago, we changed the name in the U.S. to Dealer Shop. It used to be called LAR US, and 12 months ago, we changed the name here in the U.S. to Dealer Shop. We are the largest buying group in North America with over 2,000 dealership customers and 300 collision centers, and that's really the reason why we're able to save our customers money, not only on insurance products and programs like DMBA, but on a number of other products and programs like administrative supplies, on uniforms, on office supplies. Teresa more recently has gotten into, in addition to the self-insured or fully insured health and welfare programs, but also 401k programs and even business insurance. You can find more information about the things that we offer savings on to our customers on our website, including additional details regarding our DMBA products. And with that, I will turn it over to Susan, and I know a few questions have already come in.
Yes, thank you, Bill and Teresa. That was an awesome presentation. We do have some questions, but in a few moments, we're going to start the Q&A portion of our webinar. Before we do that, I'd love to ask everyone just to please take a few minutes to fill out our survey. The survey should be popping up on your screen momentarily. If it doesn't launch, you can always click on the survey icon in your toolbar at the very bottom. All right, let's get to our first question. What is DMBA?
So Bill covered that. Dealer Shop Members Benefits Alliance. So the members of Dealer Shop are able to participate or join the DMBA as a result of being members of Dealer Shop.
Perfect. How many dependents are normally covered under employer's plan, and what should be the benchmark for an employer's portion?
So I will tell you that, in my experience, in terms of percentages, I see employers normally charging the employees somewhere between 20 and 30% of the premiums. And in terms of coverages for employees, they normally set their plans up as single, two-person, and family. I have seen single, single and spouse, and then single and family as well.
Okay. How many, or how do we become DMBA members?
On that last slide that I had presented was the website address for our company, dealershopusa.com. If you go to that website, there's a form called Get Started, and if you want to fill that out, we can get back to you very quickly on next steps on discussing the DMBA program or any of the other programs that we offer savings on for our customers.
Perfect. Next question. We recently renewed our coverage. Do we need to wait until the next open enrollment?
No. As I mentioned earlier, you can change mid-year. What we try to do when an employer is looking at a change mid-year is we want to make sure that as much as we can, we are matching their plan apples to apples, meaning that we have very little disruption on the employees. And what we then do is we work with the carrier to transition the deductibles and the co-pays so that the employee, again, has no disruption there. So if somebody's paid $200 toward a $1,000 deductible, that $200 gets transferred to the new plan, and they still only have an $800 remaining balance.
Okay. We have some really good questions coming in. Audience, if you have additional questions, keep them coming. The next question, does the DMBA have health and welfare solutions for all size companies?
So we do have solutions for all size companies. Again, most of the time when you see a smaller group, something less than a couple hundred, you'll see a fully insured program. And then when you get north of a couple hundred, 250 maybe, 300, then we start to see both fully insured and self-insured.
Perfect. How long does the process take?
So from the time we receive the information, and most of what I'm talking about when I say the information is it's already in your file somewhere out there in our customers' files. Their invoices, their plan. We usually ask for their most recent open enrollment material, et cetera. If they're self-insured or if they have large claims, we'll ask for that. But all of that usually comes in through reporting. And if they're a small employer and they haven't gotten the claims information, our underwriters are usually able to address that. But it normally takes about 30 days from the time we receive the information until we're back to you with a firm quote. And then from that, we can implement in as little as 30 to 45 days as long as we get the decisions back quickly.
Okay. Cost savings are very important, but service is very important too. What services does the DMBA offer in addition to savings?
Yep. So we offer a full service solution. We have a team of people that work to support the DMBA. We have people that help deal with claims issues as employees' issues come up. So we provide a microsite so that employees can go online and look up whatever information that they need. And we also have underwriters on staff. So the advantage to us having our own underwriters is that we're able to fully understand the employer's situation before we go to the carriers, and that helps with the negotiation.
What about a very small business, 4 to 8 employees?
So we can take on 4 to 8 employees. Generally speaking, what will happen there is that we'll have some, we'll call it 4 or 5 options that they can choose from in plan design, and then we would price it accordingly.
Okay, that's about all the time we have for our Q&A session. I'd like to remind our audience that a recording of this webinar will be available on the Auto Success and the Body Shop Business website in the next few days. Please feel free to log in to view it again or to encourage colleagues to view it. Also, look for a follow-up email directing you to the on-demand version of the webinar. This concludes our webinar. Thank you, Teresa and Bill. Thank you, audience. Everyone have a great day.
Yes, thank you.